Over the last 2 weeks, the stock market dropped more than 8%. Oil prices crossed $100 a barrel for the first time in years, and your 401k? It just took a hit, whether you checked it or not. Right now, the U.S. and Israel are in an active military conflict with Iran, and I know what you're thinking. That's a geopolitics problem, not my problem. Wrong. Every time bombs fall somewhere in the world, your gas prices go up. Your energy stocks move. Your airline stocks crash. Your portfolio shifts, whether you understand why or not. Today, I'm going to break down exactly what is happening, why your money is reacting to it, and, most importantly, what smart investors are doing right now. Let's go. Let me give you the 60-second version of what's going on, because you need context before the money talk makes any sense. Earlier this month, the United States and Israel launched military strikes against Iran. Markets opened the next morning in full panic mode. The Dow dropped 600 points at the open. S&P 500 futures were down over 1% before the bell even rang. Now here's where it gets interesting, and where most people stop paying attention, which is a massive mistake. The market actually recovered most of those losses by end of day. Why? Because Wall Street has seen this movie before. After the first Gulf War, the S&P 500 rose 16%. After the second Gulf War, up 14%. Geopolitical fear creates short-term panic. But the market often bounces. Keyword, often, not always. And the difference between those two outcomes comes down to one thing: oil. Here's what most people don't realize. Iran is one of the world's largest oil producers. When conflict breaks out in that region, global oil markets freak out because traders start pricing in the possibility that supply gets disrupted. We saw this in real time. Oil spiked 13% the morning after the strikes. That's not just a number on a screen. That's a mechanism that touches every single part of your financial life. This is the chain reaction. It starts with a missile strike in the Middle East and ends with you paying more for groceries and getting a higher credit card APR. That is not fear-mongering. That is just how economics works. Now, who wins in this environment? Energy stocks, Exxon, Chevron, ConocoPhillips, all of them surged 3 to 5% on the news. Defense contractors, up. Gold, up. These are what we call conflict beneficiaries, assets that historically outperform during geopolitical instability. And who loses? Travel, airlines, hotels, anything that depends on people moving freely and oil staying cheap. United Airlines dropped over 6% in a single morning. Marriott, Hilton, Expedia, all down hard. Okay, let's get practical. What should you actually do with this information? I'm going to break this down into 3 groups based on where you are financially. Group 1, you're just getting started. Do not panic sell. I know watching your portfolio drop feels awful, but selling during a geopolitical scare is almost always the wrong move. Look at the data. Markets historically recover. The people who locked in their losses during the COVID panic in March 2020 missed one of the greatest bull runs in history just 3 months later. Your job right now? Stay in. Keep your automatic contributions going. If anything, a down market is a sale. You're buying future growth at a discount. Or perhaps you're in group 2, we active investors. This is where it gets interesting. You've got a few areas to research. Energy ETFs, something like XLE, which tracks the energy sector, tends to perform well when oil spikes. Defense stocks, Raytheon, Lockheed, Northrop. Conflict historically means government contracts. That's how it works. I'm not giving personalized financial advice here. Always consult a professional. But these are the sectors historically tied to this kind of event. And here's one most people overlook: the VIX. That's the volatility index, Wall Street's fear gauge. When it spikes above 25 or 30, historically that's been a buying signal for the broader market within 3 to 6 months. Right now, the VIX is sitting at 26. Make of that what you will. And finally, Group 3, you're near retirement. I'll be blunt here. If you're within 5 years of retirement and heavily exposed to equities, this is your reminder to review your allocation. Not because the world is ending, it's not, but because volatility is your enemy when you're in withdrawal phase. Talk to your advisor. Rebalance if you need to. Peace of mind has a real dollar value. Here's what I want you to take away from all of this. And this is the stuff they do not teach you in school. Your money doesn't exist in a vacuum. Your financial life is connected to global events, whether you engage with them or not. The conflict in the Middle East affects what you pay at the pump. The Federal Reserve's rate decisions affect your mortgage payment. A trade war affects the cost of your phone. Everything is connected. The people who build real wealth over time aren't the ones who predict every market move. They're the ones who understand the system well enough that they don't panic when things get scary. Knowledge is the best hedge against financial anxiety, and it's free. That's exactly why I started this channel. Not to tell you what to buy or sell, but to give you the context you need to make smarter decisions with your own money. Let me leave you with this. The market is messy right now. Oil is volatile. The Fed is stuck between fighting inflation and supporting a slowing economy. Tech stocks are still 20% off their highs. It can feel overwhelming, but this is exactly the environment where educated investors separate themselves from the crowd. Not by being fearless, by being informed. If this video helped you understand what's going on and why your money is reacting the way it is, drop a like. It takes 2 seconds and it tells me this content is worth making more of. Subscribe if you're new here. Every single week on this channel, we take the biggest story in finance and break it down so it actually makes sense for your real life. And the next video, we're going deep on the Federal Reserve's current dilemma, why they're completely stuck between cutting rates and fighting inflation, and what that means for your mortgage, your savings account, and your job security. You do not want to miss that one. I'll see you then.